Students, in this video, let me discuss about how to minimize the risk exposure. As you are aware of the different types of risk and its effect on the share prices, it is also important to know the different ways to minimize the risk exposure. As every investor wants to guard himself or herself from the risk, it can be done by understanding the nature of the risk and also by careful planning. Risk could be minimized by various ways. That is, I will be explaining you how to minimize the market risk exposure, interest risk exposure, how to get protection against inflation, and also how to get protection against the business and financial risk. How to minimize the exposure to market risk. Investor has to study the price behavior of the stock. Usually history will repeat even though it is not in the perfect form. The stock that shows a growth pattern may continue to do so for some more period. The Indian stock market expects the growth pattern to continue for some more time in information technology stock and depressing conditions to continue in the textile related stock. Some stocks would be cyclical, so it is better to avoid investing in such types of stocks. The standard deviation and beta indicates the volatility of the stock. The standard deviation and beta are available for the stocks that are included in the indices. National Stock Exchange News Bulletin provides this information, and looking at the beta values, the investor can gauge the risk factor and make wise decision according to his risk resilience. Further, the investor should be prepared to hold the stock for a period of time to reap the benefits of the rising trends in the market. He should be careful in the timings of the purchase and sale of the stock. He should purchase it at the lower level and he should exit at the higher level. How to get protection against interest rate risk? One suggested solution for getting protected against interest rate risk is to hold the investment till maturity. The portfolio manager can invest in the treasury bills and the money can be reinvested in the market to suit the prevailing interest rate. The investors can also buy treasury bills and bonds of short term maturity. The portfolio manager can invest in the treasury bills and the money can be reinvested in the market to suit the prevailing interest rates. Another suggested solution is to invest in bonds with different maturity dates. When the bonds mature in different dates, reinvestment can be done according to the changes in the investment climate. Maturity diversification would yield the better results. So this is some of the ways how you can get protected against interest rate risk. How to get protected against inflation? The general opinion is that the bonds or debentures with fixed return cannot solve the problem. If bond yield is 13 to 15% with low risk factor, it would provide hedge against the inflation. Another way to avoid the risk is to have investment in short term securities and to avoid long term investment. The rising consumer price index may wipe off the real rate of return in the long run. Investment diversification can also solve this problem to a certain extent. The investor has to diversify his investment in real estates, precious metals, arts, antiques, and other collectibles, along with the investment in securities. And one cannot assure that different types of investments would provide a perfect hedge against inflation. It can minimize the loss due to the fall in the purchasing power. How to get protected against business and financial risk? In order to guard against business risk, the investor has to analyze the strength and weakness of the industry to which the company belongs. If weakness of the industry is too much of government interference in the way of rules and regulations, it is better to avoid such investment in such companies or such stocks. Analyzing the profitability trend of the company is very much essential. The calculation of standard deviation would yield the variability of the return. If there is inconsistency in the earnings, it is better to avoid it. The investor has to choose a stock of consistent track record. The financial risk should be minimized by analyzing the capital structure of the company. If the debt equity ratio is higher, the investor should have a sense of caution. Along with the capital structure analysis, he should also take into account of the interest payment. In during boom period, the investor can select a highly levered company, but not during the recession. So, students, this is how you can get a protection against various types of risks. So now, as we discussed about the different types of risks and also the protection against risk, now it is important to calculate the risk associated with different stocks. In order to calculate the risk associated with different stock, you have to measure the risk. Just understanding the nature of risk is not adequate unless the investor or analyst is capable of expressing it in some quantitative terms. Expressing the risk of a stock in quantitative terms makes it comparable with other stocks. Measurements cannot be assured of certain percent accuracy because risk is caused by numerous factors like social, political, economical, and managerial inefficiency. Measurement will provide an approximate quantification of risk. The statistical tool used to measure and used as a proxy for risk is the standard deviation. So there are different ways to calculate standard deviation during different situations. When probabilities are given along with the risk expected return, you can calculate the standard deviation and the expected return by using the formula expected return is equal to summation pi into ri will gives you the expected return, and the risk I'll tell you in the next slide that how to calculate the risk when probability is given and when probability is not given. When probability is not given and only expected returns are given, of different time periods, then the expected return could be calculated by using the formula R is equal to summation R by N. Even there is another situations where you need to calculate the expected return where when market values are given, you have to convert the market values into weights and hence you can proceed to calculate the expected return by using the formula summation Wi into Ri. So to calculate the risk, you have to use the standard deviation, which is a measure of the values of the variable around its mean, or it is the square root of the sum of the square deviations from the mean divided by the number of observances. The arithmetic mean of the returns may be same for two companies, but the return may vary widely. So the formula to calculate standard deviation when probability is given and when probability is not given is shown in this slide. We also have to calculate variance of the return, which is nothing but the square of the standard deviation. And the formula to calculate covariance is shown in the slide when probability is given and when probability is not given. Then we also have to compute the coefficient of correlation, that is the degree of relationship when two stocks are given, relationship associated between these stocks, whether they move in the same direction or they move in opposite direction with respect to their risk and return. To calculate the correlation coefficient, this is the formula that you have to make use of. And coming to beta, so as I already told you, beta represents the volatility in the market. Actually, it is the slope of the characteristic regression line. It describes the relationship between the stock's return and the market return. For example, if there is 1% change in market return and if beta value is 1.19, then we could conclude that for every 1% change in market return, the stock return would change by 1.19%. If beta is equal to plus 1, it means that for every 1% change in market return causes exactly 1% change in the stock return, and it indicates that stock moves in tandem with the market. When beta is equal to 0.5 plus 0.5, it indicates that for every 1% change in market return causes 0.5% change in the stock return, and the stock is less volatile compared to the market. If beta is equal to plus 2, it indicates that for every 1% change in market return, it causes 2% change in the stock return. The stock return is more volatile in this case. When there is a decline of 10% in the market return, the stock with a beta of 2 would give a negative return of 20%. Stocks with more than 1 beta value is considered to be risky. Negative beta value indicates that the stock return moves in the opposite direction to the market return. A stock with a negative beta of -1 would provide a return of 10%, if the market return declines by 10% and vice versa. Stocks with negative beta resist the decline in the market return, but stocks with negative returns are very rare. It is also important to calculate alpha, which is the intercept of the characteristic regression line, which is the distance between the intersection and the horizontal axis. It indicates that the stock return is independent of the market return. A positive value of alpha is a healthy sign. Positive alpha values would yield profitable return. According to the portfolio theory, in a well diversified portfolio, the average value of all stocks turns out to be zero. Correlation coefficient, as I already told you, it measures the nature and the extent of relationship between the stock market index return and the stock return during a particular period. The square of the correlation coefficient is the coefficient of determination. It gives the percentage of variation in the stock's return explained by the variation in the market return. That is, for example, if R square is 0.62, it could be interpreted as that 62% of variations in stock's return is explained by the variations in the market return. So, friends, hope it is clear about the different actions that you could take for minimizing to the risk exposure, and also how to calculate the risk and return during various situations. And also it is important to understand about the characteristic regression line, which is a simple linear regression model estimated for a particular stock against the market index return to measure its diversifiable and undiversifiable risks. And the regression model states is given by Ri is equal to alpha I plus beta I into Rm plus Ei, where R is the return of the stock I, alpha is the intercept, beta is the slope of the stock I, Rm is the return of the market, and Ei is the error term. Friends, hope it is clear about the different types of risks associated with market, risk associated with companies, and how to mitigate the risk, various types of risks associated with the individual stocks. Either it is a market risk or it is a company specific risk. And also, we discussed how to calculate the risk and return. Hope you understood about the risk and return concept, and also the significance of beta. And uh, I would thank you for your patience listening. Thank you.